If you've ever stared at a chart wondering why price moved the way it did, then you're not alone. In this video, I'm going to show you the shift that makes market movements predictable instead of confusing. Once you see this, price action stops feeling random and starts making sense. All right, so the best way to show this is obviously going through a price chart. Now, here we have a chart of the euro dollar, and this is on the 4-hour time frame. Firstly, in order to understand how to predict the market, we must understand how the markets move. Now, the books and mainstream media teach us that the markets move on buying and selling pressure. Now, that's a misconception. And throughout this YouTube channel, I'm going to show you conclusive proof and evidence why the market isn't random and that they are absolutely predictable when you know what you're looking for. Now, I'm going to go into greater detail in future lessons, but for this lesson, I'm going to keep this relatively simple. The market moves in buy and sell programs. There is a script running behind price up here that is telling the market a sell program is going to start. And that sell program is going to be delivered to a predetermined level down here. And we can absolutely predict the turning point right down here well before the market even gets to this level. Because the markets are mathematical, right? There are calculations in price, and these calculations are based on price itself. Now, if you're here, these videos aren't for beginners. There's a ton of other people on YouTube who will teach you simple stuff because they only know the simple stuff. On this channel, I'm going to delve into the deeper parts of algorithmic price delivery. And if you come in here with an open mind, you're going to glean a whole lot of insight in these videos. Now, the first thing we should notice is a defined dealing range. We have the dealing range high above this high. This is the highest high inside of all of this piece of price action. So this is a very key level that the algorithm will reference because it's the highest price in relation to all of this time. And of course, the lowest price is the dealing range low, which again is the lowest price in all of this range of time. Now, the first thing to know, every price run starts with consolidation. The market needs to engineer liquidity by holding price inside of a range. This here is your initial area of consolidation. There will be liquidity built above the market in the form of buy stops. We refer to this as buy side liquidity. And if it's sat above the dealing range high, like we do over here, we refer to this as major buy side liquidity. Below the dealing range low will be major sell side liquidity, where we will have a pool of sell stops residing, right? Now, what I'm about to show you here, students who have been through my Market Maker model program, I have literally dozens and dozens of examples that are even more precise than what I'm about to show you. The highest high of the consolidation, if I put my cursor over this, you can see that the high comes in at 1.16688. The low over here comes in at 1.16188. So there is exactly 50 pips between the high of the consolidation and the low of the consolidation. If we take this number here, so the lower number of 1.16188, and we subtract 50 pips from that number, we will get a number of 115,688. Again, there's a 50 pip difference between this price and this price. This is one deviation lower of the initial consolidation up here. Again, if we take this price at 115,688 and we subtract 50 pips from that price, we will get another price point of 115,188. Again, now this is two deviations of the initial consolidation range. If we subtract 50 pips from 1.15188, we will get a price point down here of 1.14688. That's 2 pipettes of the actual price. And yes, we can anticipate this price run. In fact, in my private mentorship group, we were looking for this price before it even printed. And I'll show you the exact level that we were looking for later on in this video, right? But for now, we can use this information to project deviations in price for potential turning points. Now, when they overlap with higher time frame key levels, we can anticipate the market to reverse and go from a sell program into a buy program. Now, let's say price was up here and we seen this sell program deliver lower, and then the market turns around. If we take the highest price and the lowest price, we can grade the range. Now look at how those levels overlap with the deviation levels. And what do I mean by that? Well, here we have the highest price. This is the dealing range high. And here we have the lowest price. This is the dealing range low. Now in between the highest price and the lowest price, we're going to have our mid price. This is our 50 DRT level. It's 50% of the range between the high and the low. So we're going to refer to this as our fair price or fair value. In between the 50 DRT level and the dealing range high, we have the 75 DRT level, which is the mid price between the 50 level and the DRT high. And then we have this orange line down here, which is the 25 DRT or the 25% between the dealing range low and the 50 DRT mid level. Now let's just pretend these candles didn't exist for a moment. The algorithm is going to refer back to these specific price points first because it's a reference point, right? The algorithm looks back and it says, okay, I can't see candlesticks. What I'm looking at is price in relation to time. So in this time period, what was the highest price up here? What was the lowest price down here? And what was the price points in between the highest price and the lowest price? Because it's already been mathematically calculated. Now let's just focus back on price and how do we predict the movement of price? The algorithm is coded on human psychology. It's designed to move in peaks and troughs to provoke emotion. And when traders are emotional, we will put money behind a trade idea. So the whole purpose of the algorithm is actually just to move price, to engineer liquidity into the marketplace. We can look at price in terms of premium versus discount. Anything above the 50 DRT level is going to be a premium market, and anything below the 50 DRT level is going to be a discount market. From the 75 DRT to the dealing range high, we're going to class this as an extreme premium, and from the 25 DRT to the dealing range low, we're going to class this as an extreme discount. Now notice what happens here. The market reprices from the turning point down here, which we already mathematically anticipated, and is repriced into an extreme premium. Now, relative to the dealing range high and the dealing range low, let's say, for example, this was the price of a car, right? There's going to be a range of what that car is worth. So if you go online and you want a rough idea of either buying or selling your car, you want to know the value of that car, you're going to have a price range. You're going to see, okay, well, which is the highest price of that particular make and model and mileage? And you're going to get a figure. The highest price that I've seen is up here, and the lowest price that I've seen is over here. A fair price for the car would be the midpoint or our 50 DRT level, right? Now, if I was selling a car, I would want to sell that car for a premium price. The best prices I'm going to get is going to be in an extreme premium, right? And notice how the market travels into an extreme premium. What does it do when it gets to the extreme premium? It sells off. And where does it go? It goes into an extreme discount. Now, if I was going to buy a car, I don't want to be buying up in an extreme premium, do I? I want to buy in an extreme discount. And when it reaches an extreme discount, what happens? The market moves higher. I'm going to show you where it goes to and why in a minute, but this is the backbone of price. Now, there has to be certain things in price that is going to give an instruction to tell the market where to move. These things are something that we call arrays in price. They are strategically located within price that are very specific, and when price reaches these specific levels, an instruction will be carried out to tell the algorithm what to do next. Now, everybody has heard of an order block in the SMC community. Very little people actually understand what they are and how to use them. But for the purposes of this presentation, we're just going to keep it simple. The highest up close body, the candle inside of the dealing range high, is going to be our high probability bearish order block. We're going to look at this up close candle here. This green candle is the highest up close candle inside of all of this price action, right? We can extend that across. The market drives straight into the order block. We touch the midpoint known as the mean threshold of the order block right there. Notice that none of the bodies closed above the midpoint of the order block. That's significant. This tells us that the market is not yet ready to move outside of the range and therefore is going to reprice. So there's going to be an instruction sent to the algorithm to say stop the buy program, start a sell program, and reprice to where? We've already reached an extreme premium, reprice to extreme discount. Where's it going to go to? Well, this is the order block, these two consecutive down close candles in an extreme discount, from order block to order block, from extreme premium to extreme discount. Now, I'll get a bit more detail with this in a second, but how is the market predictable? Well, firstly, we could predict the low forming, and we can also predict the time at what the low is going to form, generally at 9 a.m. And then what happens here is the market turns around. Now, the algorithm is programmed to do one of two things. It is going to seek liquidity, internal or external. So external being outside the range and internal being inside the range, and or is going to balance areas of inefficient price action. Above each of these internal swing highs, internal because they're inside of the range, the algorithm will reprice straight to those areas because stops are going to be positioned above these highs. As this sell program has moved lower, retail are going to trail their stops above all of these highs. The market is going to reprice straight to them. Not only that, it's also going to seek to balance areas of inefficient price action like we have here, this sell side imbalance. This is only sell side delivery. Same here, sell side delivery, and same here. The market will reprice through that range with buy side delivery straight through it, and usually it does it in quick fashion. These areas here are not areas of liquidity. This is not internal range liquidity. These areas are internal range inefficiencies. Liquidity and inefficiencies are two separate parameters. Now, obviously, there's liquidity absolutely everywhere in the market because there's always buying and selling occurring and people trailing stops and whatnot, right? But for the algorithm, it isn't reaching into a fair value gap to get liquidity or grab liquidity, as people keep saying, right? It's going there to balance an area inefficient price delivery because the market is coded on principles of fair value. It's something known as the market efficiency paradigm, right? What that means is if sell side delivery is offered, we have to offer buy-side delivery through the same range in order for it to be fair value. And again, this is why equilibrium, the 50 DRT level, the market will gravitate towards, right? Because it's the fair price. Once a fair price is established, then we can offer premium and discount. Now, watch what happens here. This high, believe it or not, comes in at 9 a.m. We have now completed our buy program inside of an extreme premium where time and price, the order block and price align, sends an instruction to deliver price lower into an extreme discount. What's it going to do? It's going to look for liquidity, internal range liquidity from this high down to this low inside of the range, and or balance areas of inefficient price action like we see here. Watch the bodies, they're not closing below the low. That's significant. Look at the price action around the 25 DRT level. We'll come back to this in a second, right? Let me just scrub to the left a little bit so you can see a little bit more past data. Look at where the market repriced to. Now, again, this is something I was talking to my students about live, right? We have equal lows below the market. There's going to have a large pool of sell side liquidity resting below these lows. Why is that? Because we're taught to place our stops below double bottoms, right? This is strong support apparently. What happens? The market drops lower, straight into that liquidity pool. Now, if we take the equal lows and the bodies of these candles up here, not the wicks. Again, this is when you get more advanced with dealing range theory. We do not use the wicks when it's a stop run. This is a stop run, and there are again rules for that, but look left here and you'll understand. We still anchor it to the equal lows. These are coded in the program. They're there as a trap specific for retail, right? Now, watch the price action between these levels, especially up here. When we get to our 75 DRT, it nails it. This level is getting its Gandalf on because it ain't letting price past, right? And not only that, it's coupled with the inversion fair value gap, making this a very strong level. And then we see the market sell off. But where does it go to? Again, let's go left. This swing high to this swing low, we have all of this inefficient price action, right? This is known as a buy-side imbalance. This is a fair value gap. Yes, there's an argument of a balanced price range, which is why we do not anticipate the whole range to be filled. This is exactly what I was telling my students when we were looking at this area. Now, why this candle here and not this candle up here? Because this candle here has already dug into part of that buy-side imbalance. If we highlight this entire range, look at the midpoint or consequent encroachment. Now watch what happens. The market drops into the consequent encroachment of that buy-side imbalance / balanced price range, leaves these two down close candles nested where? At the consequent encroachment. Note the opening price. We nailed that there. This is a high probability order block, sat inside of an extreme discount of an initial dealing range. Where is the market going to reprice to from here? The highs up here, and all the buy-side liquidity resting above the initial consolidation. This is a market maker buy program. We actually have a market maker buy program here, a market maker sell program here, and a market maker buy program here, taking us back above these highs up here. Where did the turning point come in? Well, believe it or not, 9 a.m. What does it reprice to? All the short-term highs inside of the dealing range, all the internal range liquidity and the external range liquidity ultimately sat above the dealing range high. Well, that's great, Ali. That's very hindsight cherry picked. I traded this up and down and I've shown my students this, and I actually had a ton of videos on this YouTube channel where I'm showing you my entries and exits and the whole logic behind why. But I'm not here to convince people about my trading. I'm here to convince people about the logic in algorithmic price delivery, right? Now, let's zoom out. This is the area that we were just discussing. Let's take the whole range. Here's your dealing range low. Here's your dealing range high. Here's that inefficiency that price dropped into. There's your consequent encroachment. Well, what's happened here? Well, we've got our dealing range low and our dealing range high. So we have our extreme discount down here, right? From the 25 DRT level down to the dealing range low. Well, randomly, price is entering here in an extreme discount and running higher. Well, where's it going to? Is going into an extreme premium because the market is absolutely predictable. It works on a timing mechanism. And when you understand how it works through the lens of premium and discount and price itself, it isn't price action. It's algorithmic price action. Let me take a few minutes here because this part matters more than most people realize. A lot of traders don't quit because they lose money. They quit because they're tired of feeling confused. There's a very specific kind of mental exhaustion that comes from staring at charts every day and not really knowing why price did what it did, right? You mark levels, you follow the rules, you take the trades, and then price just does something that makes absolutely no sense. And when there's no explanation, your mind doesn't get closure. It just keeps spinning, right? You replay the charts, you keep replaying the trade, and you wondered what you should have done, whether you should have waited or you should have entered earlier or entered later or done something differently. And over time, that does something subtle but very dangerous. You start losing trust in yourself. Not because you're careless or not because you're lazy, but because you're operating inside of something that feels random. And the human brain is not wired to stay calm in randomness. It freaks out. When we don't understand cause and effect, our nervous system stays, switched on. Every candle feels like a potential threat. Every pullback feels like it might be the one that ruins everything. So that's where hesitation comes from. That's where overmanagement comes from. What I want you to understand is this. Calm traders aren't normally calmer people by nature. They're calmer because the market makes sense of them. They're not emotionally detached. They're just orientated. They know why price is moving. They know what price is responding to. And because of that, they don't need to react to every fluctuation. When you start seeing that price isn't just moving, it's responding, something really shifts internally. You stop needing to be right on every trade. You stop needing immediate confirmation. You stop taking losses personally. A loss just becomes information. A win becomes confirmation of the process, not proof of worth. And this is the part that most people really miss. Understanding price is not just a technical skill. It's a psychological one because clarity reduces fear and logic reduces hesitation. Understanding literally replaces anxiety, and that's why the first real breakthrough isn't profitability, it's actually relief. And relief comes from when you finally feel like this isn't chaos anymore. There's a reason things are happening. And once that belief settles in, everything becomes much, much easier, and waiting feels easier. And that's the point of DRT. Risk feels lighter. Losses don't really spiral you anymore. So you're no longer fighting the market. You're observing it. That's the foundation all real consistency is built on. It's not effort. It's not discipline. It's not understanding. Once you truly see that price is not random, you stop trying to control it and you start learning actually how to work with it.